Good morning and welcome to the podcast for Monday the 21st of October. We start this week without the spectre of a potential US default hanging over the markets. As we all know, last week, towards the end of last week, the politicians in the US did manage to come to some form of agreement, which has seen the partial government shutdown in the US come to an end, and also the debt ceiling extended into the new year. The expectation was always that there would be some agreement reached, even though they once again managed to leave it late in the day to do so. And throughout the whole process, the stress on the markets was relatively confined. We saw it in the Treasury bills, which spiked up significantly. This is the short-dated Treasury. A number of funds chose not to hold it, hold those that were set to mature within the next couple of weeks. But subsequent to the agreement, we can see how the yields have returned back to levels that we saw a couple of weeks ago. In the equity markets, however, there was very little sign of stress throughout this whole process. The S&P 500 has never really been more than about 5% below its all-time high. So looking back over the last few years, if we look back, we're not really going to see any real evidence of the potential drama that we went through over the last couple of weeks. We compare that to 2011, where we had about a 17% pullback in the markets. So much more pronounced the first time we went through this scenario. This time the market's really adopting a we've seen it all before kind of attitude. One of the things that the events of the past few weeks has done is clouded the economic picture. There is likely to have been some impact on economic growth, the extent to which we should see come through in Q4 numbers. But also there are a number of data releases which should have been released in the last 2 weeks, which we haven't received. And also it might take some time for this data to work through the system. So there's potential distortion of some of the data coming up in the next couple of weeks. If you combine these factors together with the new deadlines which have been set and which go into the early part of next year, it seems very unlikely that the Fed will now seek to reduce stimulus in the economy. So the whole taper decision of the Fed, which is data dependent, is likely to have been pushed back into next year, probably around March time. This is helping, giving a boost to equity markets. The S&P 500 closed up in another record high on Friday. And also we've seen the US Treasury benefit. The yield on the 10-year Treasury, which hit 3% during the taper talk back in September, has now come back down, is around about the 2.58, 2.6% level. Of course, one of the data points which the Fed is looking at quite closely is the employment data. The non-farm payrolls data, which was due to have been released on the 4th of October, we didn't get then. We now expect to get this tomorrow. The expectation is that we'll see 180,000 jobs added in September, and the unemployment rate stay at the current 7.3%. Remember that the Fed was looking to complete its tapering exercise by the time the unemployment rate reached 7%, and then to consider raising interest rates once the unemployment rate reaches 6.5% or below that level. Of course, it's not only in the US where employment is a key metric of the bank in monetary policy decisions. We know that the Bank of England has also introduced a threshold whereby it does not intend to raise rates until the unemployment rate in the UK reaches 7%. This, the Bank of England doesn't expect to happen until 2016 at the earliest. Although we had some data out last week which showed the unemployment rate in the UK staying steady at 7.7%, there are some indications that there is momentum building in the employment market. The unemployment claimant count reduced to levels which we haven't seen since about 1997. And also the number of people employed has also increased by more than has been anticipated. So there is a chance that if we continue to see this momentum in the labour market, and also that if the Bank of England doesn't get the productivity improvement that it expects from the labour market, then we may see the unemployment rate come down faster than the Bank of England currently expects. If we look ahead to what we have on this week, the Q3 GDP forecast is due out in the UK, for the UK as well, and that comes out on Friday. Given the relatively strong economic data points which we have seen in the UK over the past few months, we have seen forecasts tick up quite markedly for 2013 and 2014 for the UK. So the Q3 figure will be something which does command a bit of attention on Friday. The expectation there is that we will see about 0.8% quarter-on-quarter growth for Q3. Looking to the Eurozone, we've got some PMI data out from the Eurozone. We expect to see a continuation of expansion in both the manufacturing and services sectors of the region, as the region continues to emerge from recession. And then back onto the US, we've got existing home sales today and various other housing market data points out this week. Of course, the housing market is an important factor in the wealth effect, which is important for an economy such as the US, which is consumer-led. Also out of the US, we have some consumer confidence data. This comes out on Friday. The initial reading of this University of Michigan did show that there had been some impact from the government shutdown on consumer sentiment. So we'll be taking a look at that figure as well to see the extent of the hit to consumer confidence that the events of the past few weeks has had. And then moving on to the corporate reporting season, this is in full flow now. Looking ahead this week, there are a number of our research teams covered stocks reporting. Starting with one of the companies is Amazon. This is due to report on Thursday. It's been a very strong performer over the past few years, and our research team are looking for a continuation of strong sales growth and a bottoming of margins at Amazon, and also for some news on the progress made at the cloud computing part of the business, Amazon Web Services. And staying in the US, there's also Boeing reporting this week, another strong performer. What we'll be looking for there is any impact on the defense business from the US budget shutdown, the US government shutdown and budget issues. Moving on to the UK, WPP, looking here for continued strong growth in the UK and the US, and then potentially some signs of weakness in the emerging markets. We'll be looking to see if there's any evidence of that. And then lastly, Unilever. This is a company which had a very disappointing report at the back end of September, on the 30th of September, and that saw the shares sell off as a result of that warning. Our research team saw that sell-off as an opportunity to buy the stock, and they have released a research report recently on that. So please do ask your broker for a copy of that research report.